let's start recording here. And then let me just get set up. And then, yeah. I'll be using the chat in the live stream. So if anyone has any questions during the live, please feel free. I'm honestly, my teaching style is not, I don't care if I'm interrupted, especially with this class. So this class is going to go over what was discussed in the previous 2 or 3 classes. But it's not as like definition based. It's more like how do we use what was previously taught to actually enter a trade and like have your own bias and thoughts towards the market. So we got 60 slides and strap in. Okay, so the agenda for today, the first few slides are going to be a little bit boring, but we're going to talk about forming your system, how to journal, trust your trades, and that sort of thing. We'll do a very brief previously learned section. So if you did not watch the class on liquidity, or I believe the previous one was FVGs and change in state of deliveries, this class might be a little bit more difficult for you, simply because I'm going to be referring to those things as if you already knew them. Okay? We'll talk about like how to form a daily bias. So like when you wake up in the morning and you open up your trading view, like how the fuck do I trade this? We'll discuss that. I'm going to walk through like 5 or 6 trade executions, quick session on what to avoid, and then just a quick little recap at the end. So previously learned, the first class was on liquidity, and I think that when it comes to ICT trading, everyone says that this is what matters the most, and I have to agree. There is liquidity is how the market moves, and that's what it draws towards. So if you don't understand, if you're bullish, you don't understand what liquidity is lying above, that'll make it very difficult for you. Sorry, 1 second here. Can you guys not hear me? Or can we? For real? Okay, so some people can hear me and some can't. Sorry, I guess we'll figure this out right now. Okay. Well, if it's him that can't hear, it doesn't matter because he should know all this anyways. So let's keep going here. So back to the previously learned section. And if you guys can't hear me, we might just have to do the recording portion of it that I'll post on YouTube. So yeah, liquidity. Basically, it's so simple, and I think that some people potentially just don't understand it. But in the grand scheme, it is, it really is not difficult. You have a range. If what you're trading is in a range, that range has a high and it has a low. And that stock, or whether it be like SPY or QQQ, it is going to either go to one of those 2 areas of liquidity, depending on like your higher time frame, and whether the market is in a buy or a sell model. Part 2 of what was already taught was on FEGs. So an FEG is really simple, and I go into this in a little bit, but about like the 90-10 thing. Like 90% of trading's mental, 10% is like actually knowing how to market an FVG and all that shit. But for the sake of this class, an FVG is a 3-candle sequence where in a bullish instance, the top wick of the first candle and the bottom wick of the third candle have a gap in between them, thus creating a fair value gap here, and then the same thing in the case of a bearish fair value gap. Now, the change in state of delivery. So we're going to talk about CSDs pretty much this entire class because I'm a confirmation trader. So I'm going to hit on this a lot throughout the class, and a lot of these setups are going to look very similar. But for this graphic here, we have equal lows ran. We get a sharp move back up, and this is a weekly chart, by the way. All these numbers are effed up, though. But we get a V-shaped reversal off of equal lows, and our weekly candle closes above this first down close candle here. So we have 2 down close candles. We close above the first one, right? That's a change in state of delivery. Because those form when you basically mitigate a series of down close or up close candles. So in this case, it's a bullish change in state of delivery. Now what happens from here is this low becomes a protected low, which, to explain that, basically means if price is going to move higher into an external liquidity pool, this low should not be touched. Okay? So CSD closure above, and then you could frame your trade on a lower time frame to take it into your external buy side liquidity. Now, talking about like trading systems, I think that if I had to be completely honest, most people don't have them. They don't really have a system that they trade. So they either like take alerts and maybe just don't understand them. Or they trade different things every day. And what that basically does is sets you back a lot, because if there's no consistency in what you're doing, it's really hard to build any sort of longevity in the market. And this honestly goes for everything. Like if you're practicing 20 different things, how are you going to be good? You can't be good at all 20, right? So if you kind of modify your system, bring it down to like 1 or 2 things, and then you get really good at that, then you have a trading system that you can rely on, built on journaling, live execution. You trust the system at that point, right? And there's so much more to having a system, but that's kind of the point of why you should have a trading style. All right, so how do you know if your system works? Well, if you have a system or something that you like to trade and you journal it, which means you put all of the info for the day and why you took that trade, and you take note of it, then you can see consistent data on what works and what doesn't. Like maybe you shit the bed when you trade in the afternoon versus the morning, like things like that. Live execution. I know a lot of people get stuck on they trade evals, but they can't trade on a funded account. And that's just because the funded account, the eval is like the gateway to making money when you're trading futures. But once you get to the funded portion, that's like you're trading kind of live capital. Not really, but you are. You have more money into that, into that account. So it's a little more high stress. And yes, Eddie, this will be recorded. And then combining journaling and live execution, that builds trust in your system and the trades that you take. Okay, so journaling. Like I said, a lot of people probably don't do this because it's not fun. It's like doing busy work at your job. It's not like there's not a due date on it. There's journaling is not going to make you money, but it keeps you honest with your trading. And if you journal, then you just have, like I said earlier, the opportunity to find consistencies and inconsistencies in your trading. So what I currently do is I have a separate Discord, just a private Discord for myself. I put all my trades into that. Like what time of day it is, whether I lost, whether I won, was there high impact news, all of that stuff, because there's so many factors that we have to think about when we're taking trades. Like if we're trading a no news Monday, I wouldn't say that's like a cop out to taking a loss, but you know that you shouldn't really be fully hands on with the market on a no news Monday. You could also use Slack to keep records and data. And then, yeah, like I said earlier, if you're taking different setups every day, how are you supposed to be confident in what you're taking if you're taking a bunch of bullshit trades, right? Okay, live execution. So when I started trading, I did the whole thing where I lost money and then I studied in my room for like 3 or 4 hours a day after I worked a 9 to 5. And I came out of that knowing how to chart, being really confident where price is going to go. But I still had like just terrible execution. And that brings in this point that I'm trying to make here, is that what we're teaching you guys in these classes is just like a framework of how we trade. But like the other 90% of trading is the ability to enter something and take a loss and walk away and not be a bitch and overtrade, blow your accounts, and then cry about it. Like that's the 90% that's really hard for people. And trading live capital is it's just different. Like you have the opportunity to make money, where if you're paper trading, people like to take like just absurd sizing and trade it like it doesn't matter, because I mean obviously it doesn't, because you're not making money. But nobody treats paper trading like it's live capital. You're not as picky with the entries you take, and I do think there's a benefit there, but you'll really build your emotional strength trading live capital. Yes, Guru, it will be recorded. Let me just type that in the chat. There we go. Okay. So there's live execution. So identifying bias. Now, this slide is kind of whack, but it's whack because we're going to be talking about bias throughout the next 50 slides. But bias is where you believe the market is going to draw for the day. This could be different, like, if you're trading a weekly or a monthly chart, obviously your bias is going to not be on a daily time frame. But for the purpose of this, we're thinking about when you wake up in the morning, like what do you see in the market? So yeah, we're going to mark out our highs and our lows, and then we have to kind of use what we learned in prior classes to tell us whether that's going to, are we bullish or bearish on the day? And then one thing with ICT, and especially if you're early on ICT, if your bias is incorrect, you are going to see all of our PD arrays we discussed not work. You're going to see FVGs not hold. You're going to see order blocks get inversed. You're going to see, whatever it might be. Nothing is going to work if your bias is incorrect. And like I said earlier, being on side with price, it's the most important part, because it's kind of like the main thing in ICT trading, and then we could add all of our other things as well to help us out there. So morning preparation. When you wake up, and for the sake of this chart here, we're thinking It's about to be 9:30. The market's about to open. What do we see? How do we mark it out? So we have a weekly high here. So this would be our external liquidity. We just want to put that there because that is a target. If we do end up pushing higher from here, we would want to have that weekly high as one of our take profits if we're long. And then we have our Tuesday high. That's just another, any like daily high or low is pretty significant. And then in this case, we have previous daily low that got swept already before the market opened. And then we have Asia high. In this case, London's not really offering anything. It's not offering a swing high or low, so I wouldn't care about it or mark it. But this is what you should do every single morning. Put your liquidity levels on your chart, and it'll help you a lot in the long run. Okay, this example is kind of a repeat, so we'll skip over it. All right, we're going to go over this again because I think this is very important, especially if we're building a trading system and my trading system. It goes like liquidity. Do we get a reaction? That gives us an opportunity. If we get a reaction, then we use our other things to trade it. But yeah, why is liquidity important? Because it's on every time frame, whether we're expecting a big or a small move. It's the extremes of a range, and it ultimately gives you confidence in your bearish or bullish bias, right? So like when I look at this chart here, we have a high and we have a low, and from the looks of this chart, and if I looked at this at 9:30 in the morning when we're about to open, I would say I think this is going to go higher, right? And I'm going to go into the day with that bias that I'm only going to long if a opportunity presents itself to draw into this liquidity pool up here. Okay. Hold on. Is this the same? No, it's not the same chart. Okay. Here's another example of what marking out your liquidity levels look like. London low, Friday low, previous day high, all important levels of liquidity. This is your external liquidity. Previous day high is your external liquidity as well. Everything else in the middle is just a range. And then we have our London low as well. This is the boring part of the class, but I'm going to just, I'm going over it because I think it's really important. This is an example on gold, right? We have our high up here, which is our external buy side liquidity. And we have a low right here, which would be our external sell side liquidity, right? So what you want to see as an ICT trader is a sell side liquidity area getting swept right here. Then you think ding, ding, ding. We have an opportunity. Doesn't mean we're going to, but we have an opportunity to trade this higher into our external pool of liquidity. Okay. And then for the people that missed the first class, the whole thing behind liquidity is that so basically this is a pretty big wick here on gold, and there's buyers that they're entering at this area right here. So if you're buying here at the bottom and it pushes higher, the logical level to put a stop loss would be right under this low. Or people that are buying here, they're probably putting their stop loss just under this low, because that's when they think, oh shit, it's breaking support, so it's going to go lower when I get stopped out. And then you can see all of retail gets stopped out here, and we trade higher to stop out retail traders that entered short at this area up here. Okay? Hopefully that makes sense. And then here's just another example. Buy side, sell side. We sweep sell side right here. This gives us an opportunity to trade it higher. Okay? And you can see here, it's a 4-hour chart, takes a long time, but we end up going to both extremes of the range. Now, when external liquidity is hit, I know that, just being in the Discord, some people just buy the sweep, right? So that's called turtle soup. I don't trade that. I'm super picky with the trades that I take, and I always want some sort of confirmation, and almost just like mirroring every single trade that I take. I want them to be similar or the same. Obviously, every instance in the market is different, so not every trade you take will be similar, but I try to have some sort of consistency to it. So when we sweep an external liquidity pool, that creates an opportunity. That is where, for example, if we're sweeping a buy side level and, thinking about it in ICT terms, that is where everyone is taking their profit. And then also shorts are getting stopped out there as well. So when that sweeps, that gives us an opportunity to potentially short, right? And basically we'll go over the examples here. It's kind of hard to put this into words without showing charts. I'm a big visual learner, so hope you all are too, because we're about to rip through so many charts. It's kind of insane. All right, so now that we discussed liquidity, that's the first kind of segment into my trading style. We need a liquidity sweep or some sort of draw that's telling me we're going to go to that area. Now, how do we confirm that we are on side with price? So this is where we use those PD arrays that were taught in previous classes, like the CSD or FVG. One thing we did not go over this time, but have went over in previous classes, is a breaker. But a lot of change in state of deliveries are basically breakers as well. And then order blocks are CSDs as well. So I'm not sure if that was hit on in the previous class, but we'll talk about it a bit tonight. All right, so now that we have the liquidity sweep, we could add in our change in state of delivery. This would be my ideal setup if I'm waking up at 9:30, remember, and I'm looking at the market, and this is what it's opening like. I would expect it to trade into this area up here. Now, the reason that I believe that is because we have bullish SMT. We have an hourly change in state of delivery. But now, how do we trade this? If we get an hourly change in state of delivery, that doesn't just mean, buy that, because hourly candles are typically massive and they can trade hundreds of points in 60 minutes. So once we get a liquidity sweep, we want to move down to our lower time frames, like our 15-minute and our 5-minute, and we could trade off of those confirmations to make us get entries to go higher. So for this example here, we have our Friday low, previous day high. We have our London low as well, marked out. We have a 1-hour change in state of delivery, and we have a 4-hour order block. So obviously the order block's not showing on the chart because this is a 1-hour chart, but it's right here. So if we're V-shaping off of a low, right, a V-shape is just like it hits a low and snaps back up. That's what you want to see to trade higher. And we're trading back into a 4-hour order block. That's telling me that price is probably going to be supported and push higher. So yep, 1-hour CSD. Let's look at the lower time frame. So now if we move to the same chart on a 15-minute, what happens after the 1-hour change in state of delivery is we chopped, right? So a couple up close candles after, down close, just a bunch of bullshit. And then you could see that we had this one candle here that closed above these two down close candles. We would not want to take this because if we're confirming that price is going to go higher, it should happen quick. And when I say quick, I mean the change in state of delivery on the lower time frame should happen relatively quick. So now we kind of keep this in mind, but we're not going to enter off of it. We're going to enter off of a big expansion candle like this one. Okay. So once we get this big expansion candle out of the range, it is confirming that our 4-hour order block is most likely going to hold, and our 1-hour CSD is going to hold because we're getting like a 90-point 15-minute candle pushing higher. Now, how would I frame this trade to enter it? Well, this is the part of when I was sitting down making this class that was so difficult because everything is so different. Like, there's no point in time where all these charts look exactly the same because they never do. But in this case, I want to just explain in hindsight, right, how you could take this trade. So the thought process is we get a 15-minute expansion candle on top of a 1-hour expansion candle. We have our high up here at 25,030. Now, if we enter off of this 15-minute change in state of delivery, that would be a 70-point stop, right? And the stop loss that we're going to set, and I'm going to go over this a little bit more later, but we're going to set our stop loss at this down close candle's low because this turns into a change in state of delivery, and then it also, those two down close candles also, that's an order block. So if price is going to deliver to this high, it is not going to come back down into this low. So that is why we set our stop loss there. If it does trade down into this low, then we're wrong. And it's most likely going to go to this London low area here. Okay? So for the sake of this, we have a 70-point stop, 75-point stop. The TP up here is like 140 points. Right? That's a 2-hour trade. So you're either going to lose 70 points, make 140. Right? That's how we frame every trade, 2-hour trade, to make it, worth it. And then you can see it fully played out here on the 1-hour chart. And then it all started from this 1-hour change in state of delivery. And we get expansion into the open into our previous day high. Okay? And this is, a clean setup that I would, if presented every day, we would make a shitload of money. But we have to adjust in this market because it's been brutal. Okay, so if you have any questions on that, please post them in the live stream chat. If you don't have any questions, then I'm going to continue. Okay, and like I said, you have to practice this stuff for it to make sense. Me going over like 5 or 6 charts, it's going to be a little bit difficult. But yeah, I'll obviously potentially do another class after this, or just these are the trades that we take all week, so you can learn from those as well. So for our second example here, like I mentioned, sorry, my neighbor upstairs is so fucking annoying. One second. I'm going to answer this question. So it doesn't only apply to futures. You're only going to have London and Asia sessions with futures because they trade 23 hours a day, right? 5 days a week, 23 hours a day. But no, like I trade shares off this same exact model. You could trade options off this model. You could trade gold, oil. It works for everything. It's universal. Bitcoin. There's just a different experience that you need when you're looking at, if you're buying shares, it's just a little bit different. Stop losses need to be a bit wider sometimes because I don't know. I wouldn't want like a $25 stop loss on a share play that I do. So it just has to make sense risk reward wise. All right, let's get into the second example here. If this is market open, we get a 15-minute closure below the first candle in this sequence, right? Change in state of delivery is right here. Closes below it. You could also see that these highs on the left got taken out as well. So this could also kind of look like a manipulation because we range throughout the night, we get a pop, and then it instantly drops. So coming into the day, I would say we are bearish. We are targeting this low right here at 25,334 for the sake of this example. So now we don't want to short this previous 15-minute down close candle because it closes at 25,498 and the high is at 25,5 like 90 or something. So it's a 100-point stop loss. So we don't want to trade this. We want to move down to our lower time frame. So we'll go from like a 15-minute to a 5-minute or a 3-minute chart. And this is the 5-minute example here. So within that 15-minute candle, we get 2 5-minute bearish fair value gaps. Now, if we are on side with price and we are going to deliver lower into that external liquidity pool that I mentioned on the previous slide, these 5-minute gaps should hold. So what do? We could enter off the CE here. We have a 50-point stop instead of a 100-point stop, right? Because we're putting our stops at the high. If it runs this high, you're wrong. It's probably going to go higher. And then we are going to trade this lower for 2R. So for the sake of this example, 50-point stop, 100-point take profit, even though what we are targeting is much lower on the chart. Now, here's another way to trade it. If you don't trust adding a 5-minute fair value gap, or if you don't trust fair value gaps at all, you could play a continuation change in state of delivery, right? So for the people that were in Owls and Kess was in there talking about this H pattern, which I'm not going to lie, thought it was kind of bullshit. Besides the point, you'd want to see a kind of similar thing happen here. So remember, we have our 15-minute bearish change in state of delivery. We get a pop into a 5-minute gap. We don't want to add that yet. We want to add on another change in state of delivery, right? So this up close candle, we close below it. That's a CSD. Then we could take this trade as well, right? So this would be a 464 entry. So this is right around a 70-point stop because this high should be protected now. And then we can trade it lower into our actual draw on liquidity that we mentioned before. And I believe that is like 140 points, maybe like 130. So a little less than 2R. Or we can trade the 5-minute FVG after we get multiple confirmations that this is going lower. We reject the 5-minute fair value gap up here. Then we could add this one. It's pretty flexible, and there's a lot of ways that you could trade this. And this is like ideal trading conditions for me, right? Because if we get bearish confirmation on a higher time frame and it just continues to mitigate any up close candles, yes, this is most likely going to continue slamming into our drawn liquidity that we are targeting down here. And then let's look at the 3-minute. So we have this is the same as this 5-minute gap here, right? So I don't want to add the 5-minute gap. Okay, well then maybe you can move down to the 3-minute. We close below this up close candle after rejecting the 5-minute FVG. We could enter off of that at 25,441 here. And now our stop loss is 37 points. So the lower that you go on the time frame, your stop losses should also be tighter stop losses. So like I said, 37-point stop loss here. This tool is only showing a 74-point profit. But as you can see, we end up hitting the full drawn liquidity here. Does that make sense? It's a lot that I just said, but I want you guys to understand how we got from this to this. All right. If we don't have any questions, I will move on. Actually, let me check one thing real quick. Okay, cool. We are good. And then you can see it fully played out here. You can use it for scalping and swinging. Yeah. We've been in a range for, I don't know, 6 months now. So I don't technically scalp. And I've honestly stopped swinging as well. I typically take one trade a day, and then I'll lose $250 on a 0 day till expiration in the afternoon. So it's kind of been my memo lately. Alrighty, let's go into another example here. And again, you guys are going to see similarities in these, and I'm showing you that it works. So if you feel kind of lost with your trading, this could potentially be your new system. Okay, so we get SMT here at this low. SMT, I don't know if this was discussed in previous classes. I'm not really sure. But I'll just explain it again real quick. SMT is when, so we have correlated assets, right? So NQ, ES, YM, those are correlated assets. They all typically move the same for the most part. YM is a little bit different lately. It's usually down a lot more, but you know, NQ and ES are typically pretty in sync. So Bunny, this is bullish SMT because the other asset, which would be ES, took this low, right? So this is just another one of those things, like I said earlier, it's an opportunity to think about higher prices because ES took this low, NQ did not. So SMT is typically when reversals happen. So, like I said, liquidity sweep is what starts it. We have SMT here. NQ is a stronger asset because it did not take it. We get a 30-minute change in state of delivery above this candle here. And then we also get another 30-minute CSD above these two down close candles here, right? So this is where I would 10,000% be confident that price is going to this area here. Like this would be, the lights are going off to be in a trade to the upside. Okay. So you could trade this based off of the 30-minute change in state of delivery. It pulls back into a 5-minute FVG, and this would be your 2R. Now, I was going over this and like the prices earlier, and it's kind of funny because this chart looks like it moves a ton, but it's not a big move at all. But I think it's a great example to learn. So if you add the 5-minute FVG, right, because you're already bullish, 2 30-minute CSDs happened. You're already bullish. Actually, I think it might have been one. I can't remember if this is from the first or the second one. But you add 25,658. This trade does not work out if it hits this low, which is like a 20-point stop loss, and then you have a 40-point take profit. Right? So you're either going to lose 20 or you're going to make 40. But that's adding the fair value gap. Now, You could also trade this based on the second set of confirmation. We get the CSD here. We get a pullback on the 5 minute. Hits the FVG, but you don't trust it, so you don't take it. And then we close above the first down close candle in the sequence. You could add it here at 670, and it trades higher into our dull. Okay? This is pretty much exactly how the last example went when I was talking about you don't have to add FVGs. And I think a lot of people think that ICT is just fair value gaps. But I think when we taught this class previously, like last year, we just kept thinking about how most fair value gaps don't matter. But when you have all of your all the things in your system working on the trade, that's when you could add an FVG. But if you just see like one random ass inversion fair value gap, you're gonna get fucking screwed. Because just trading an IFVG like that, there's so many other things you have to kind of think about before you take that trade. Okay. All right. So just for some notes, you will not catch these trades tomorrow or today or tonight. It's basically just about knowing what to look for based off of this class and previous classes. The whole point of these examples is to show you, right? The starting thing to the system is a liquidity sweep. We get reversal confirmation. We use those PD arrays to trade higher or lower. So when that happens, we should expect to take a trade to the liquidity that has not been taken yet. Okay? I'm going to take a drink real quick. Alrighty. Here is another example. And this one was made with AI ChatGPT slop. I put the chart in there and it fucked it all up. Not this one. This one actually looks pretty good, but the other one looks terrible. So, like I mentioned before, did we get a liquidity sweep? Yep. We swept it down here. Did we get a V-shape reversal with a change in state of delivery? Yep. Closed above these two candles here. Now we think long. Do we have clear targets? Yep. Asia high. 1, 2, 3. How can I fit a trade into this area here to go higher? Really simple. Well, it might not be for most, but when you think about it and you see these key points hit, it does end up being pretty simple. Okay, so how do I trade this? Well, we get this huge expansion here. And this is a lower time frame, by the way. And then this is where like the AI slop shit the bed. We got a CSD here, but it just took so long. 1, 2, 3, 4, 5, 6 candles to close above this one here. That doesn't tell me that it wants to go higher just yet. But then we get 2 down close candles and an expansion candle off of that. That's what interests me. So then you could add it just off of the CSD here, and you put your stop between, below the, at the order block low, right? And like I mentioned before, a change in state of delivery, that forms an order block. So the order block low is where I would put my stop loss because that is a protected low now. And then here you can see kind of how it plays out, right? So we close above these 2 candles here. We could add it off of that, frame a 2-hour trade with a stop loss at the low, and then we take our profit up here. Makes sense? Example 2. So this is where I just got sick and tired of this shit. Constantly uploading it into ChatGPT for it to spit out some just terrible chart. But yeah, so you can see 2 lows were hit. So we have this low. This is technically an equal low. It did sweep it, but we didn't get full expansion. It just expanded into an internal level. But ideally, we would want to trade an expansion that gets us into this level up here. So once this sweeps, this is where, as an ICT trader, you should be taking profit at this level down here, because you know once liquidity sweeps and you trust it, you know that it could potentially reverse higher. And then I just moved back to my other charts because ChatGPT was annoying me. But you can see what happened here. It just V-shaped right off this low. This is market open, a 30-minute candle, just absolutely nukes to the upside. Closes above these 2 down close candles. Then we want to look for a trade. I didn't go over everything on this trade because while I do think it is a good example of a reaction V-shaped CSD higher, this is a massive range. This is like 500 points in the span of an hour and a half. So I'm not going to go to the lower time frame. This is more so just for the visual purpose of it. But one thing that I do not talk about in this class, but I will right now, you have so much flexibility with options when it comes to this. And you, how do I say it? Stop losses are, I don't know, if you size for 0 on options, you could hold that shit all day. And it doesn't matter where your entry is, because if you're right, this could pull back into here and still go to this high. Or you could add the CSD here, but like a 60-point stop on futures, it's much harder to just to add off of this. But yeah, you can see the full trade play out right here. Range low to range high. Okay, so damn, I must be flying through this. So, like I mentioned before, 2R. It's your risk to reward. So for the sake of this example, if you are risking 15 points, you would want your take profit to be double that. So, that would be 30 points. It creates balance, and you technically only need to win 33% of the time to be a break-even trader, right? So if you take, for the sole purpose of this, the math, if you take 2 losses for 15 points and then your third trade you win 30 points, then you're break even. But if you're not following a system like that, it's where you're kind of consistent with your take profits and your stop losses. It's just hard to be profitable if you're taking like 22-point wins but 30-point losses. Like, how do you have to win a lot more to be profitable at that point. Okay. And then, like I said, protected highs and lows. So when a CSD forms, the up or down closed candles that are being mitigated become a protected swing point. So for this example, it's a bearish example, obviously. We have some down closed candles. And even for this, look, we have this big down closed candle at the top, 2 up closed candles, and then we have 3 more down closed candles. If you added this order block here, the CSD or order block, when it pops into it, your stop loss is up here, which is like a 60-point stop loss. And then it just does the same shit. Like, how do you know you're on side with the continuation model? We have expansion, chop, expansion, 1 candle that goes up, and we expand lower. Every single up close candle on this downside move just gets completely wrecked. So like I said, for the sake of this, if you add on the CSD, this is your protected high, and then you could use a 2R method there. And then you can see if you miss this one, we expand lower, 2 up close candles, and we close below it. It does the exact same shit, and you could set your stop loss above this as it trades lower. Right? So I'm really trying to preach the consistency here, the protected highs and lows. Often we had Rob saying, oh, like 7 a.m.'s low is protected. That's probably because there was like a 30-minute CSD or like an hourly CSD. He doesn't want to see that low revisited if New York's open is going to push us higher. Here's another example. Hold on, let me take a drink real quick. So we have a bunch of lows. We have 2 down close candles here. And we close above it. And we have a 30-minute fair value gap. A CSD, sorry guys. Since this class hasn't been too long, I'll go over real quick. Can you guys see my mouse as I move it? Or no? Okay, cool. So a change in state of delivery is if price is delivering lower and we hit a liquidity point, a CSD is like telling you, flashing at you, that price might reverse, right? So in this case, we're in a sell model, constant sell model. And then we have these 2 down close candles right here, right? And then we have 2 up close candles. When we close above the first down close candle in this sequence, that is a change in the state of delivery. That tells me price might start delivering higher now, based off of us closing over these 2 candles. Now a change in state of delivery that I'm not even going over, that wasn't a part of this class, but for example, you see these 2 up close candles here? For the sake of this, let's say we're targeting this low down here. And we have these 2 up close candles here. And then it just gets destroyed by 1 candle. That is a change in state of delivery. Right? Price thinking about going higher. Nope. We close below the first up close candle, so we would mark that with our red little line. We could enter off of that if you want to. And then we want to see it trade into this area down here. This up close candle's highest point is our protected high. And then you can see that, looking at this chart here, this maybe looks like a 40 or a 50 point stop loss. If you want to target 100 points, you're getting that. It ends up hitting 100 points for 2R. Doesn't hit your low, but it hits 100 points. Now, for the sake of this example, I don't know if liquidity is swept. I was kind of just going over 2R here, so I must have pulled a half-ass example, I guess. But we close above these 2 down close candles here, right? And a CSD is not closing above the wick. It is closing above the body, above or below the body of the candle, right? This is just a bullish change in state of delivery because we're going from bearish, flip the switch, now we're going bullish. We're going to attack that other side of the range. As I mentioned, we're trading from range to range on the daily time frame. So now we want to frame this higher. We have a 30-minute fair value gap. Boom, you could add that right here. You have your protected low down here. You could put your stop loss there. And then we trade for 2R higher. And then one thing that I did not mention, and I might have a slide on it. I'm not 100% sure. So you see how we expand out of here in this we're talking about this change in state of delivery. We have a down close candle up here. And we get another one right here. So we have, this is the example from earlier, by the way. When I went to the 15-minute chart and we got one God candle, we're like, okay, we're going to long it because this is going higher. You know that you're on side with a bullish change in state of delivery if every down close candle just keeps getting mitigated. If you have a down close candle right here, okay, we'll close above that. Down close candle here, we fly above it. This is telling you that your initial thought process is probably going to play out and go attack those highs. Okay? Now, some pain points with this. If the CSD takes too long, you're most likely going from an expansion phase into a consolidation phase. And if I had to be completely honest, the last 6 months of the market has been exactly that. We're expanding. The only movement we're getting is like 1 or 2 hours of expansion, and the rest just fucking sits there and does nothing. I think like last Tuesday or Wednesday, we literally chopped the entire fucking day. It's like the most disgusting chart I've ever seen in my life. So if you want to see a CSD happen quick, you don't want to trade this shit. Like, what is this? This is dog shit. We hit this low. We close above this candle here. We want to see it go higher. And look what it does. We have 3 down close candle, pops above, doesn't do shit. 3 down close candles, pops above, doesn't do shit. Chops, chops, chops. Takes 7 candles to even get back up to this high. Slams again. Then we close above it here. I don't know what happens after this, but my guess is it probably just did this shit. Okay? So you want to see, what you would want to see is this candle right here. Closes above it. These 3 down close candle. Boom. You want to see a big candle telling you that we're going to go for this high up here. You don't want to get stuck in a move down and then you get chopped, because usually when you go from expansion, accumulation is typically met with more expansion, which means we go lower. You want to see a V shape and then constant confirmation that this is going to be a reversal and not accumulation. Okay? I don't really remember this slide, but we will go over it. All right, so we have our highs up here. We have our lows down here with SMT, bullish SMT, remember? ES took this low, NQ didn't. Did I already have this example? I think I did. And I think I went over what I was explaining here on that example. But, yeah. 30-minute CSD, we hit an internal high, and this is where, like, shit, are we going higher or are we going back down? And this is where the other form of confirmation comes in. Pull back, expansion higher, and then we go even higher. Got it? You don't want to see, if you're bullish and want to see this, you don't want it to hit this area here and sharply move back down. Expansion met with expansion. And then on the lower time frame, this is probably consolidation, expansion. Bias for stocks. I'm just going over previous plays that I traded. I don't really have, if we're talking like options or like 4-hour swings, it's not my thing. I'm really not good at it. I bought the high on Meta last week on options and just got absolutely wrecked. I don't think they were green for a second. I bought them at 636, and I'm pretty sure Meta's at 590 right now. So that's why I didn't include this in this class, because I'm just not very good at that. That's why I really don't trade options that much to begin with. But if you want to learn how to trade the things that I'm telling you in this class, look at stocks, look at the weekly, look at the monthly. That is when they're the cleanest possible moves are on the weekly and the monthly on just common names. And then the other thing about this is you have to be a little bit more patient, right? So you're going to, maybe it takes 3 months for this to play out, 4 months, but you're entering off a weekly and a monthly chart. You're not entering off a 5-minute chart that you want to see play out in 30 minutes. So just some food for thought there. Framing a trade on shares and equities. This is tech. This was my love. This is one that everyone ruled out and hated and didn't like. They thought it was a shitty play. Mr. 8-Ball. But for this example, right, this is a monthly chart. Each one of these candles represents a month of price. We get a change in state of delivery here. We have a monthly FVG. I'm like, let's just add the monthly FVG, right? We add it here at 41. Our protected low is down here. We're not setting our stop that low. If it's going to trade through this monthly FVG, we're wrong. You know? And we want to see it hit $56 from 41, so that's $15 up. And you know, for the sake of 2R, you could have your stop loss at like 34, which is down here at the monthly FEG's low. And you can see what happens. Straight ripper. But this is a super clean chart. And this is, tech was like gold and silver based, so when gold and silver started booming, obviously this followed suit. Okay. Just a quick example there. Like I said, the monthly charts are really clean, can really help people out. Target. So this is another one. And I also just think Target was beat down when I bought this. But, and I bought this lower, I'm pretty sure. But we had a liquidity sweep, change in state of delivery on the weekly chart. We could add the FVG here. So like a $94 entry. We want to trade into this internal high at 108. And then this high up here was the, I believe, top of the monthly fair value gap. So that's just another area we want to target. You can see where we ended up moving on this trade. We expanded into internal, pullback, change in state of delivery above these two down close candles. And then we hit our draw on liquidity up here at 123. All right. To cap this off, I'm going to go over one more example. I don't remember what this one looks like. Okay. So this is NQ 15-minute chart. We have our lows here that created SMT with ES. Bullish SMT. This is definitely a news candle too, by the way. Or no. No, this is the 9:30 open. So 9:30 open happens. We get a Judas swing. So I don't know. This probably wasn't taught in the other classes, but a Judas swing is basically when the market's like ranging before the open, and it'll just make a massive move in one direction and then get bought up right away. In the case of this candle, you could see right overnight, it chopped, slams at the open so much that ES takes this low, which is previous day low, and then it rips right back up. So now if this happens, we have a 230 point candle here. We're going to want to trade it into this high up here. Let's change state of delivery. We have a 5-minute fair value gap. We don't want to add this because it's massive. This would be just about a 100-point stop loss if we just enter this 5-minute FVG. So now we want to wait for the confirmation. It closes above this down close candle here. Closes all the way up here. So, I mean, technically you could add this right here to take into that high up here, right? This low is protected. This would have been a much better example if it like pulled back into this fair value gap. But trying to find these examples is actually extremely difficult. Okay. Yeah, that's it. That is the